Could this regulatory pressure we're seeing from not just Beijing, but DC lead to even more companies decoupling and delisting from the U.S.?
It's guaranteed. There will certainly be further delistings. It's not on the level that's being kind of purported across the board that all Chinese companies will have to delist, and likewise that no future Chinese companies seeking U.S. public markets will be allowed to do so. But certainly there will be future delistings, as you said, both as the result of a push-pull from both capitals.
Which companies? Alibaba, Baidu, JD, they all had successful debuts when they went public here in the U.S.
Again, I think it's going to be those that have the most amount of sensitive data. So in the case of Didi, a delisting was actually not unanticipated by those of us that kind of saw the turbulence around their IPO 5-6 months ago. Didi as a company, for instance, holds a lot of very sensitive national geospatial data. They obviously hold consumer data on over 550 million users. And then we're obviously falling afoul of certain operating conditions here in China. And the authorities here thought they didn't have the ability to kind of control that if the company was listed abroad. So I think companies that fall into those sectors and have that level of sensitive data could see pressure to delist, relist in Hong Kong.
If they do delist, Ben, how does that impact these companies' ability to raise capital? I imagine that U.S. investors then have less exposure, right? I mean, it's a little harder to invest in these companies if they're not listed here. There's always ways you can get around that. But how does that affect their ability to raise funds, liquidity, or can they be just as successful but just listing in Hong Kong?
So I think Hong Kong is today a very modern and robust and highly liquid global market, not one that's certainly restricted to mainland investors. And there are obviously plenty of companies that most American institutional investors have in their portfolios today. They're in that market. And so actually the influx of these companies coming home should bolster and make that a stronger market. I remember speaking with Charles Lee several years ago, who was deeply disappointed that companies like Alibaba, Tencent had gone public in markets outside of mainland or outside of Greater China. And so that fear hopefully is being assuaged by this. And I think ultimately could yield a market that's much more liquid and obviously one that's very easily accessible for global investors.
The weakness in Chinese tech stocks, do you think that changes in 2022, Ben?
So certainly we're in an environment of uncertainty right now. Investors hate uncertainty. They hate unpredictability. It's been challenging to read the tea leaves and understand and translate even the primary text, for instance, of that edict that came out yesterday from the CSRC. And so what is critical is that the Chinese government finds a way to communicate, to translate, and to effectively forecast and explain the rationale behind these decisions in many instances which are highly understandable and logical and even within the designs of what American policymakers have sought for our national businesses as well. So if they're able to do that, I think a lot of these stocks could bounce back because they're being depressed artificially, and the market fundamentals and the fundamentals of these businesses don't justify the valuations at which they're sitting today.
Yeah, erratic moves in Chinese names in the last couple of months. It's also coincided with more money flowing into India. A number of companies there going public in recent weeks, from Paytm to Zomato. I'm wondering if that's a market you are watching, or pivoting some of the money from China to markets like India that have less regulatory concerns.
So obviously, India is inaccessible for Chinese capital today, largely for Chinese corporates and venture capital firms. You saw a significant push towards India starting middle of last year when a lot of these nationalist sentiments were rising. There was obviously this massive round raised by Reliance Jio and other companies that saw global investors piling into the market. There's a lot of exuberance for India, and we as a firm invest in the market as well and are quite excited to be investing both at the venture and growth stages there. The fundamentals are strong, the populace is huge, and because of things like UPI, low data costs from Reliance Jio and others, it's a market that's very susceptible to the growth of new technology platforms. And so we're quite bullish on India. We remain bullish on China as well, but certainly as a next exciting market, India is certainly one that's attracting capital.
Although with any market, profitability will be key, especially for a lot of these newer companies that have gone public. Taking a step back and looking at emerging markets, Ben, we're in this cycle where we're expecting the Fed to taper a bit faster than expected because of inflationary concerns we are seeing here in the U.S. Typically, higher interest rates in the U.S. is bad news for emerging markets that sit on a lot of U.S. denominated debt. Is that something you are worried about?
It will certainly have a trickle-down effect across the board on public markets, on availability of capital, on interest rates within the emerging markets in which we are operating. And we invest both in South Asia, Southeast Asia, the Middle East, and even Latin America. To date, also in the private markets, in those markets, we're seeing a lot of inflation and valuations in companies exceeding our highest expected levels. And so it's certainly been a rocking party in emerging markets over the last year or so with the availability of capital as it is. That could slow, and obviously it's key that companies and investors look to those stable businesses that haven't been riding this inflationary high.